Here is the Black-Scholes formula. Every option trader on Earth uses it. Look at the inputs it needs: spot price, strike, interest rate, volatility, time. Notice what is not there. There is no mu, no expected return on the stock. Whether the stock is expected to grow at 20% a year or 5% a year, the option price is exactly the same. To see why, watch this. Same Brownian motion. Drift it with mu and the stock follows the path you would expect in the real world. Drift the same Brownian motion with R, the risk-free rate, and you get a different path. Same noise. Two drifts, two worlds. The bridge between them is one number. The market price of risk, theta, mu minus R over sigma. For these parameters, exactly 0.25. Add this much drift to the second world and you recover the first. Subtract it and you go the other way. This is risk-neutral pricing. Today we answer the question every textbook leaves dangling. Why does mu vanish? And why is the answer the deepest theorem in finance? Take the simplest possible market. One step, the stock is at 100. Either it goes up to 110 or down to 90. Real-world probabilities, 60% up, 40% down. On this stock, you sell a call option struck at 100. It pays 10 if the stock goes up, 0 if it goes down. What is this option worth today? Approach number 1. The obvious one. Take the expected payoff using real probabilities. 60% times 10 plus 40% times 0 equals 6. Discount that back at the risk-free rate. 6 times 0.9512. 571. Looks reasonable. It is wrong. Approach number 2, replication. Build a portfolio of stock and cash that pays exactly the same as the option in both states. 2 unknowns, 2 equations. The delta, your share count, is 1/2, and you borrow $42.81 at the risk-free rate. Cost today, half a share at 100 is $50 minus the $42.81 you borrowed. 719. 2 prices for the same option. Buy from the naive seller at 571, replicate at 719, and you pocket $1.49. The same in every future, no risk. Markets do not allow that. There is one price, and it equals an expected discount, but with a different probability, Q star, 0.7564. Plug it in, and the no arbitrage price falls right out. Q star is bigger than P. It is not the real-world probability of going up. It lives somewhere else. Next, we ask where. Last section, Q star showed up out of nowhere. The right probability. But what does it mean to swap one probability for another? Here's the world under P. Some events have positive probability. Some events are impossible. Measure 0. Same world, different measure Q. Different sizes, same impossible events. When 2 measures agree on what is impossible, we call them equivalent. They share the same 0 sets. If P and Q agree on what is impossible, every Q probability is just a reweighting of a P probability. Call the weighting Z. Z of omega is Q over P, 2 states, 2 weights, Z up equals 1.26. The up state is overweighted. Z down equals 0.61. The down state is underweighted. Multiply P by Z and you recover Q, and the average of Z under P is exactly 1. This gives us the master formula of measure change. The expectation under Q of any quantity X equals the expectation under P of Z times X. Try it on the option payoff. Direct under Q, 0.7564 times 10 equals 7.56. Reweighted under P, 0.6 times 1.26 times 10. Same number. Discount it back and you get 719. The exact replication price from last section. 2 states is a toy. The real market has uncountably many Brownian paths. We need a Z that lives on the entire path space. Here it is. Z at time t equals e to the minus theta wt minus half theta squared t. Mind the sign. It is minus theta, not plus. The most common mistake in this whole subject, it is positive. Its mean under P is 1, and it transfers expectations from P to Q exactly the way our 2-state Z did. We have already met it. Ep09 called it the exponential martingale. Next, the result that makes risk-neutral pricing actually work. Girsanov's theorem. We have a Z, we have a measure Q, now we put them to work. In section 3, we ended with a formula on the screen, Ju Z at time t equals e to the minus theta wt minus half theta squared t. Here is what it actually does. Watch this process. Take a Brownian motion, add a deterministic drift, theta times t. Theta is our market price of risk, 0.25. Call the sum x. Under the physical measure P, X is a Brownian motion with drift. You can see the drift. The path tilts upward on average. Now I want to ask a strange question. Can we make this drift disappear without touching the path? Algebraically, of course we can. Subtract theta times t. What is left is a pure Brownian motion. No drift. But this is too easy. We change the path. We deform the geometry to get the answer we wanted. Girsanov's idea is more radical and much more useful. Do not touch the path. Leave every point exactly where it is. Change the lens through which you measure probabilities. Change the measure. Under the lens P, this path drifts upward. Most paths in the P ensemble look like this. Under a different lens Q, the same path is a pure Brownian motion. It looks like a typical sample of a measure with no drift. The path never moved. The measure did. Here is the theorem that makes this rigorous. Girsanov, 1960, defined z at time t to be e to the minus theta wt minus half theta squared t. Mind the sign once more, minus theta. If you write plus, the construction breaks. Use z at time t to define a new measure q. The Radon-Nikodym derivative of q with respect to p is exactly zt. Then w tilde equal to w plus theta t is a standard Brownian motion under q. The drifted process under p becomes the pure process under q. There is one technical condition, Novikov. It says the expected exponential of half the squared theta is finite. Without it, z fails to be a true martingale, and the construction collapses. For our constant theta, it reduces to e to the 0.03125, about 1.03, finite. The condition holds. Now apply this to the stock. This is what we have been building toward for 10 episodes. Under P, the stock has drift mu, the real-world expected return. Substitute W tilde for W using Girsanov's identity and rearrange the SDE. Under Q, the drift is R, the risk-free rate. Mu is gone. This is the answer to Section 1's question. Black-Scholes contains no mu because in the world used to price options, no mu exists. The lens has been changed. Proof in 5 lines. Define Z, apply iti. Novikov gives a true martingale. Z defines Q. Latouvy's characterization makes W tilde a Brownian motion under Q. Every step relies on machinery you already have, from Ep9 and earlier. One more piece and the picture is complete. Next, we show the discounted stock as a fair game under Q. We left Section 4 with a half-finished result. Under Q, the stock has drift ER, not mu, but it still has a drift. Look at the equation. The first term, R times S times dt, is the drift. A drift means the price is still expected to grow, not a martingale. Not yet fair. But there is one more move. Discount the stock. Define S hat to be e to the minus RT times ST. Apply Ito. Compute the 3 partial derivatives time stock, second derivative, which is 0 since the discount is linear and S substitute into the Ito formula. Expand the ds using Section 4's Q equation. And here is the magic. 2 drift terms, equal in size, opposite in sign. They cancel exactly. What remains is sigma S hat dw tilde. No drift, pure noise. S hat is a Q martingale. Let me show you what that looks like. Stock prices discounted under Q. 20 independent paths. Some end high, some end low. The spread is real. But watch the white line. That is the average across all 20 paths at every instant. It stays close to 100. The starting price, empirically about 103. Theoretically, exactly 100. The discounted Q stock is fair. Now the payoff. The martingale property says, the conditional Q expectation of S hat at time t, given everything up to time t equals S hat at t, multiply both sides by e to the RT. ST equals the conditional expectation of e to the minus R times t minus t times ST. Replace ST with any payoff function, phi of ST. The value at time t equals the conditional Q expectation of the discounted payoff. This is the risk-neutral pricing formula. Every option pricing model in the last 50 years sits underneath this line. One question remains. When does Q exist, and when is it unique? We have a pricing formula, 5 sections of work distilled into one line, but the whole thing rests on Q, and 2 questions hang over it. Does Q actually exist, or did we just write down a hopeful symbol that may not refer to anything? And if Q exists, is it unique, or could 2 different Qs give 2 different prices for the same option? 2 theorems, both from 1981, settle the matter. First fundamental theorem of asset pricing, Harrison and Pliska. On the left, a market with no arbitrage. No riskless way to make money from nothing, no free lunch. On the right, an equivalent Martingale measure. A measure Q under which every discounted asset is a fair game. These two are equivalent. If the market admits no arbitrage, a pricing measure must exist. If a pricing measure exists, no arbitrage is possible. Existence is guaranteed by the absence of free lunches. For our Black-Scholes market, theta equals 0.25. Plug it into Girsanov. Q is constructed, Q exists. Second fundamental theorem, market completeness. Every contingent payoff, every call, every put, every exotic can be replicated by trading the underlying. Nothing is out of reach. And on the right, Q is unique. Only one pricing measure consistent with no arbitrage. These two are equivalent. Replication everywhere. And the price is pinned down. Replication missing somewhere. And the price has wiggle room. Black-Scholes has one risk source and one traded asset. That balance gives completeness. And so every European payoff has a unique price. This is the moment Black-Scholes earns its name. But what about the markets where this fails? Real markets, in fact. Stochastic volatility like Heston. Two Brownian motions drive the dynamics. Only the stock is traded. The volatility risk is uncovered. Infinitely many Qs. Jump diffusion like Merton. The jump size distribution is not pinned by no arbitrage alone. Again, infinitely many Qs. When Q is not unique, you do not get a price. You get a band of prices. Different traders using different Qs can disagree, and both be free of arbitrage. We will return to these models in Ep15 and 16. Next, we close the loop. 5 sections, 1 formula, every result we have built. 6 sections in. Let me show you what we have actually built. This formula, V equals the Q expectation of the discounted payoff. It looks like one tool among many. It is not. It is the source. Ep2 derived option prices from binomial replication. Take that limit, refine the tree, and the answer converges to 10.45. Ep4 computed option prices by Monte Carlo averaging. Run enough samples, and the average converges to 10.45. Ep10 derived the Black-Scholes PDE. Apply the Feynman-Kac theorem, and the solution evaluates to 10.45. 3 derivations. 3 apparently different methods. All sit underneath one Q expectation. Now look at this. On the left, the formula we have used all episode. The Q expectation of F equals the P expectation of Z times Fz is the Radon-Nikodym derivative dQ over dP. On the right, a formula from machine learning, statistics, and reinforcement learning. The expectation of F under Q equals the expectation of F under P, weighted by WW, is the ratio of the densities Q over P. These are the same equation, not analogous, not related, identical, down to the symbols. The technique they call importance sampling, when applied to deep out-of-the-money options, delivers about 50 times the variance reduction of plain Monte Carlo. Same speed up, same math, 2 fields. It does not stop there. The Kullback-Leibler divergence between 2 measures is the Q expectation of log Z. Variational autoencoders, variational inference. Every modern generative model has a KL term. Every KL term is underneath an expectation of a log Radon-Nikodym density. In off-policy reinforcement learning, the importance ratio is a product of policy ratios over time steps. That product is the discrete time analog of ZT finance, statistics, deep learning, reinforcement learning. 1 identity, 4 costumes. Let me close with 3 sentences. First, Q is an accounting device, not a real probability. It exists because no arbitrage requires it to. Second, Girsanov is the translator. It tells us how to move between P and Q. Third, machine learning is solving the same problem under a different name. In Ep13, theta returns, this time as the CAPM market premium. In Ep14, we will live in both worlds at once. Risk under P, pricing under Q. 1 identity, 2 worlds, same math. One more thought before we close. Risk-neutral pricing is not a tool just for stock options. Everything we built today applies far beyond options. Equities under Q, bonds under the T forward measure, foreign exchange between 2 domestic measures, credit under the survival measure. Same machinery, different numeraire. Pick the right reference asset, change the measure accordingly. But here is what working quants actually do. They do not live only under Q. Pricing is one job, there are others. Under P, the real-world measure, they compute risk, value at risk, conditional VR, scenario analysis, P&L attribution. These are questions about the world as it actually behaves. Under Q, they price and hedge, options, exotics, calibration. These are questions about consistency under no arbitrage. Same trader, same desk. Two measures used in parallel every day. Ep14 will make this explicit. And one last surprise. Remember theta, the market price of risk. Mu minus R divided by sigma. We met it in section 4. We will meet it again. Today, theta is the market price of risk. In Ep13, the same expression, mu minus R over sigma, is the Sharpe ratio, and the slope of the capital market line. Same formula, 3 names. Risk-neutral pricing meets equilibrium asset pricing. We are in the middle of phase 2. Ep12 sits at the heart of it. 6 episodes built the machinery. 2 more bring it home. Thank you for staying through. The math is the same, only the lens changes.